Will the Japanese yen be the next major currency to fail? Japan is in a bit of a predicament. On one hand, their yields for their Japanese government bonds are rising faster and faster, which is not good. On the other hand, their currency is starting to lose value, and Japan is experiencing inflation for the first time in decades. In this video, we're going to cover this predicament that Japan is in and talk about what it means for their currency and if their currency could be the next major currency to go down. Before we get started, please make sure to like the video and subscribe to the YouTube. Really appreciate your support. I'm also going to put a QR code down below for a Bitcoin tip. So if you want to support the channel, feel free to leave me a little tip. Now let's get into it. Japan is in a catch-22, a lose-lose situation where they have to decide, do we want to support our debt market or our currency? Japan is a highly indebted country, and they are actually in a debt spiral where their debt is just continuing to get worse and worse. And this debt spiral eventually leads to currency failure. We're going to cover why that is in a couple of moments here. But let's start off by talking about Japan's debt. Japan is highly indebted. They have around 1,333 trillion yen in debt. That's equivalent to $8 to $10 trillion. And the United States actually has more debt than Japan. We have around 38 trillion to 39 trillion in debt. But the thing about the United States is we're a much larger country and we produce a lot more. A great metric for measuring how manageable a country's debt is the debt to GDP ratio. What the debt to GDP ratio does is it compares the debt of a country to how much that country is actually producing. If a country has a low debt to GDP ratio, it's telling us that their debt may be more manageable and they may be able to produce more and pay that debt off or lessen that debt. But when a debt to GDP ratio is very high, it's telling us that the amount of debt this country has is not manageable, and it's going to be a lot harder for them to pay off that debt. When we look at the debt to GDP ratio of Japan, it's one of the highest out there. It's around 230%. You compare that to the debt to GDP ratio of the United States. Ours is 124%, around there, which is still not great. And I actually think that both of these countries are fucked when it comes to paying off their debt. The thing about debt is the more it stacks up, the more interest you have to pay, and this interest kind of turns into a monster, right? The United States, for example, is paying over $1 trillion in interest on their debt every year. That is an unproductive expense that the government has to look to cover. This leads to wider deficits, and the problem just gets worse and worse. Looking over the Japanese bonds, yields have been rising super fast lately, which is very alarming. When yields are going up, it means that Japan is paying more and more in interest on their debt, and this just leads to their debt growing faster and faster. The reason that yields are going up is because, like we just talked about, Japan has a ton of debt. The supply of their debt, the supply of their government bonds just continues to go up, and it's just simple supply and demand. When the supply of an asset goes up, you just see less demand. Less people trust in that asset. So if a Japanese government bond is yielding 2% and nobody wants to buy it there, the yields have to spike up maybe to 3% in order to incentivize more people to buy up that government bond. Let's go ahead and take a look at a little chart of the 30-year Japanese government bond yield over the past 5 years. As you can see, it's gone from around 0% up to around 3.6%. Bond yields have really been skying up higher over the past 5 years here, and this is leading to Japan's debt problem accelerating. Looking over to the yen, Japan's currency, it has been losing value, and the main place where we're seeing this is with its exchange rate against the US dollar. So let's go ahead and take a look at a little chart of that. As you can see, the yen has been falling against the dollar. Currently, 1 yen is worth around 0.6% of a US dollar, and 1 US dollar will buy you around 158 yen, somewhere around there. So the yen has fallen around 35% against the dollar over the past 5 years. Japan is actually starting to experience inflation. If you're not familiar with Japan's situation, Japan has been experiencing deflation for decades, and this is because they had this huge asset bubble that popped around 1990 and led to prices falling for a long time. It led to less demand in the country, it led to less production, and this is actually what caused Japan to become so indebted, because they weren't producing that much and the government was spending a lot of money trying to save their economy. They ran these huge deficits that led to them getting a ton of debt. And the Bank of Japan has actually been buying up their government debt for a long time, trying to keep yields low to incentivize more borrowing, right? If bond yields are low, it means that interest rates across the economy are low, and also to incentivize spending in order order to boost demand. But honestly, we know that really doesn't work. Money printing can't just spur demand. You can give people money, but it comes back to bite you in the ass. And recently, it's coming back to bite them in the ass. From 2005 to 2021, Japan didn't see their prices rising. They actually saw their prices falling in most years. And it's not until 2022 that they started to experience inflation. And their current inflation rate is sitting around 2 to 3%. And this has put the Bank of Japan in a bit of a predicament, because the Bank of Japan has been buying up their Japanese government bonds for a long time and keeping yields low so their debt doesn't spiral out of control too fast. But to do that, they need to print money, and now they're a little bit more hesitant to print money because it's going to lead to more inflation and it's going to lead to the Japanese yen devaluing more. So this leads us into our dilemma. On one hand, Japanese government debt is losing value. On the other hand, their currency, the yen, is losing value. If the Bank of Japan decides to support the debt market, they're going to hurt their currency. If they decide to support the currency, they're going to neglect their debt market. So the way I see it, the Bank of Japan has two options and they're not great. If the Bank of Japan does not buy up these Japanese government bonds, if they don't create demand, then we won't see demand for Japanese government bonds. Yields will continue to rise. This will lead to Japan going into more and more debt. As they go into more and more debt and more Japanese government bonds need to be issued, there will be even less demand, less trust in this asset, and yields will just start to skyrocket. And this option's not great because it eventually leads to the Bank of Japan coming in and buying up the debt because no one else will. When they do that, they need to print a ton of money, and that leads to the currency failing eventually. The second option is that the Bank of Japan can support the debt market. I believe this is the better option because if people lose trust in the debt market, which you could argue maybe they already have, then the whole game is over. So if the Bank of Japan buys up these Japanese government bonds and keeps yields at a manageable level, then it can lead to their currency lasting a little bit longer. However, this means more money printing, which means the supply of the yen is moving up faster, and this leads to the yen losing value. I just think with the second option that the yen is going to lose value slower over time. Whichever option the Bank of Japan rolls with, the outcome is going to be the same. It's going to be currency failure, and the only thing we can really speculate on is the time frame. I'm guessing that the Bank of Japan is going to do a mix of these options. They're going to try to support the debt market, but they're not going to try to do it too much because they don't want to weaken the currency. If Japan and the Bank of Japan can keep confidence in their debt market, in these Japanese government bonds, at least somewhat, I think they can keep this thing going for a while. Japan isn't experiencing serious inflation yet. It's only 2 to 3%. And the thing about Japan's economy and their country is that this is a country full of savers. These are people that don't really spend their money that much. If the Bank of Japan is printing a lot of money, a lot of that money might not make it out into the economy. One place where it might go is into their stock market. If we take a look at a chart of the Nikkei index, which is their main index over there in Japan over the past 5 years, you can see that it's been doing very well. And in 2025, Japanese stocks had a great year. So if the money supply is growing in Japan and people aren't trusting in their debt market, then a lot of people may look to invest in their stock market. Now, we have concluded that Japan is in an unfixable situation. They're in a debt spiral and headed towards currency failure. However, there are a couple of strategic moves that Japan can take to slow down this debt spiral. Japan is the largest foreign holder of US Treasuries. As of November 2025, they hold around $1.2 trillion worth of US Treasuries. And if Japan wants to support their debt market, one thing they can do is they can sell out of these US Treasuries and buy up these Japanese government bonds. This will do a couple of things. One, it will lower yields for those Japanese government bonds, and it will also weaken the dollar and lead to the yen appreciating against the dollar, which is going to support their currency. So this is a strategic move that I think Japan is eventually going to pull out. They're holding on to all of these US Treasuries, and I really don't think it's the greatest asset to be holding. If I was Japan, I would probably be selling out of these US Treasuries at some point and supporting my own debt market. Another thing that Japan can do, and maybe they can sell off their US Treasuries to do this, is they can buy up Bitcoin Bitcoin. Bitcoin is a very undervalued asset when you understand what it is doing, the fact that it is replacing the existing monetary system. If Japan can build a nice Bitcoin position and acquire a lot, and the price of Bitcoin goes up a lot, then the Bank of Japan can sell that Bitcoin and use that Bitcoin to pay down their debt. Now, this isn't going to solve their debt problem. It's unfixable, but if they can pay down a good portion of it with those Bitcoin holdings, it can slow down this debt spiral and help them be in a better position. So those are two strategic moves that I think we could see Japan take. I'm not sure if they're going to do the Bitcoin thing. I think it would be smart, but a lot of countries have been hesitant to do that and start stacking Bitcoin, but they could make a bold move and be one of the first countries to start stacking Bitcoin aggressively. So we will see what happens. I think that Japan is kind of fucked and that the yen will be one of the next major currencies to collapse. The question is just, when is it going to happen? That's going to wrap it up for this one. If you didn't like and subscribe, please make sure to do that now. Thanks for watching. I'll be back soon.